What is going on YouTube? It's Sank and we are back with another one. Now in this drop, what I want to do is pour some water over the fire that is the stock market right now, giving some focus to these China stocks because there's been some major price action. So I'm going to put a few plays in the spotlight, give you guys the coverage on them and what we are doing as next steps, so you guys are always one step ahead of the game. So as always, in this one I've got a jam-packed one for you. Now before I get this show on the road, all I ask from you guys that you hit that like button for me. Now before we get into things, our first pit stop of the evening is going to be Tesla. So I'm going to give you guys some coverage on this play since the market has had one session to digest their earnings. Now first up, what I want to say to you guys is a great quarter from Tesla, blowing through both revenue and earnings per share estimates. And in this quarter, they silenced a lot of the critics because one of the recurring comments was they don't make net income from their vehicles. They rely on regulatory credits. But this case, $750 million came from their vehicles. Now for us as investors, it's a good result because we know Tesla can easily hit their revenue numbers. It's simple for them to do that. But when it comes to net income, that was what we were looking for. We were looking for that progression, that increase in net income, and they delivered on that front. Now, if you check out the stock price on the day, you would have thought it was any average day for Tesla out there in the market. And this is because, guys, as I said to you before, Tesla is a play that is in the spotlight. And this could be a blessing and a curse for the play. Often starts off as a blessing. Investors are excited, they bid the price up, then becomes a curse as the investors become very demanding and harsh on the play. So it's almost as if no matter what they come out with, the stock price doesn't move up. Now, as I've said to you guys before, a recurring theme is going to be the chip shortage. As a matter of fact, this goes across the board for all of these automotive plays because of the supply constraints. This just means the play won't be able to operate at its maximum ability. Now, if you add that to the increase in raw material prices, you add that to the increase in imports because of shipping charges. Now, on a side note, you already know we move in the right lanes in these markets to capture all of the opportunities. So whereas we might forego some returns in Tesla, we are positioned in the sweet spot to take full advantage of these higher shipping prices with our play the nails. But back to Tesla. That just means it's going to be a volatile year for the play and they won't be able to reach their maximum potential. But I want you guys to know, these issues, these headwinds, they are short term. They are coming out with new models. The play is building momentum and they can move in different verticals to add additional market share. Now that being said, the strategy, the move of this one is we are staying long in the play because of how much potential there is. So entry on this one still remains the same. That's sub $600. Maximum $610 for entry in the play or to increase your existing position for the upside over the next couple of months. Now in terms of price target on this one, as I say, because of the supply issues, now they've been able to navigate them well, still come out with great earnings, and we should expect good numbers for their next couple of quarters for the rest of the year. I am lowering that price target on the play to $700 to $720. So it's still upside from this current price, but this is a play that will come alive next year. Next up, guys, that's NIO. Now I'm going to talk to you about this one in context with the rest of the China stocks because we are seeing increasing tensions with the US and China, but also more regulation, more scrutiny on these China stocks, and that's causing a ripple effect across the board with China stocks listed on US exchanges. Now, even though NIO is not directly involved in any of these investigations, they are guilty by association. That's why you're seeing this one come down to these types of levels today. But I'm going to cool some nerves and show you guys this. If we just zoom out, look at the bigger picture, this one is dropped down to the high 30s, yes, but they're still in that consolidation channel they've been in over the last couple of months. So it's not like you're seeing this one break through key support or drop to levels we haven't seen before. So the stock is trading at comfortable levels. But I'll let you guys know this. When we originally got into NIO, there was no talks of delisting. There was no scrutiny on China stocks. So our original investment thesis has been altered. So that means the risk of holding this play has increased. So for guidance, the move with this one is that NIO should be out of your top 10 positions. As a matter of fact, every Chinese stock should be out of your top 10 positions. And you go about this by either increasing your positions in your other plays, whether that's an Apple or any other play that you've got in the top 10, or what you do is you trim some profit next time NIO has a run upwards just to de-risk from this one. As I say, it's all about making strategic moves as investors. Now, given this one's been on such a pullback over the last couple of sessions, a bounce is coming, so I'm just giving you guys a heads up on that. But we'll let you guys know we could trend down further. As I say, we could drop to the mid 30s, where that's $34, $35 before we see a bounce up. and the bounce up is likely to come on a broad-based green day that we see across the board in these markets. Now we're still going to maintain a long position in NIO just because there's a lot of potential here. We know they've got a strong brand. We know the technology is increasing. We know their deliveries are building momentum. So there's still opportunity for us as investors. But as I say, the risk has been heightened and we just need to do a little bit of de-risking. I've given you guys the move. The next one I've got for that's ticker symbol SE, that's C Limited. Now I just want to give you guys some coverage on this one. This is one that we've done phenomenally well over the year, but just like the rest of the China plays, this one's come down in the markets today. But check this, they have come down to the top of that consolidation channel at the 270 mark. So it's not a buy where they're at right now, because technically speaking, this play could drop down right to the bottom of the channel, which is $200. Now that would be an almighty fall from these types of levels. But as I say, time to time, these markets can move wild. So the move of this one is, if you're like me and you're already up the money, you made great profits on this one, you take out 25 to 50% of your holding at this level, because there's too many headwinds when it comes to these China plays listed on UX exchanges. So as I say, right now, you take the profit from this play and they go on your watch list, pullback watch list. If we see this one hit 225, we can re-enter the play. But as I say, take 25 to 50%, leave the rest in to run on this one. Alright guys, so those are the plays I've got from this one and the moves to make with. So if you've been in the markets today, you'll know we got hit with a red day across the board. And for those who've been tuned into the channel for a while now, you know from time to time, we get slammed with these flash red days. And use this as an opportunity to give you guys a little bit of guidance on how we handle a situation like this. But first up, there should be no selling on a day like today, because if you just wait for the next couple of green days, you'd have made more money. Now in terms of how to handle a red day like today, you guys got to detach from the stock price and the business. You're investing into the business, not the stock price. The stock price is going to be completely uncorrelated to the business on a day like today. And the easiest way to detach the stock price from the business on a day like today, you guys just go and read the last earnings report. You'll see the play increase revenues by this amount year on year, increase net income this amount year on year, and they're gaining momentum and they're going places. Okay, so that's the easiest way to just remain focused on the business, completely detached from the stock price. You should only be focused on that stock price on a day like today if you're looking to buy in and make money on the rebound. So if you've been rocking with the channel, you know what time it is. Thanks for another great video. Do you suggest any ETFs for investments? Thanks for all you do. Alright guys, to wrap this one up and to share some of you. Now remember, your ETF allows you a simple way to invest into a basket of stocks all at once. And in doing so, you immediately increase your diversification. I know that's something a lot of you still struggle with. You still have those 1, 2, 3 plays which carry your entire portfolio, and you guys can see the disadvantage of that. Now in doing so, it reduces your risk because you remain diversified. Now hitting success with an ETF is all about ensuring you are positioned in the right types of trends in these markets. So I'm gonna drop 2 ETFs for you guys to consider making entry that will close out the year strong. First up, I've got iShares SP500 Consumer Discretionary. This is a phenomenal ETF to be in because consumer discretionary, which if you guys didn't know, are companies that sell non-essential items but are desirable. This is a great position to be in. Plays like Revolve, that's a consumer discretionary stock that we're hitting the numbers in, and they will also close out the year strong. But getting into an ETF, I say, allows you to invest in a collection of these plays all at once. Now, consumers are still sitting on a lot of cash. They have spending power, and we know there's several events which is going to promote that spending, whether it's the socials, the events, the back to school. All of these things are going to play into the favor of these consumer discretionary stocks. So make sure you guys go and check out this one. And the second ETF I've got for that's iShares SP500 Financial Sector. Now guys, these finance plays kicked off Q2 earnings season this year in style, blowing through estimates and targets, so they are doing well. And remember, they benefit in an inflation environment as well. These finance plays right now, they're just in consolidation mode, so they're trading sideways. I'm expecting them to pick up steam as we move through the rest of the year. So it's a good opportunity for you guys to make great returns in an ETF which captures the market. So those are the 2 ETFs I've got for you. One capturing consumer discretionaries, the other on financials. Alright guys, that wraps up for this one. If you've got any questions for me, drop them down below and I'll get back to you. I want to say I appreciate you guys as always. On your way out, light up that comment section for me. If you're new, join the movement, and I'll catch you on the next one.